country's energy sector has released results early this morning. In fact, they're out today. Our next guest says that the company ended the year on a high note. He is a longtime analyst who has covered this sector. Randy Ollenberger is Managing Director of Oil and Gas Equity Research at BMO Capital Markets. Randy, great to have you here. You are upbeat on these numbers. You say Canadian Natural delivered strong financial and operating results with cash flow exceeding expectations, but then you go on to say immediately the cash flow beat was primarily driven by lower cash taxes. When a bank reports better than expected earnings per share because of lower taxes, that analysts are always are often calling that a low quality beat. How should we understand CNQ beating expectations on cash flow primarily because of lower taxes?
Well, I mean, they beat expectations, again, primarily because of lower cash taxes. But I mean, production was also 2% better than expected, and we're seeing, good trends on operating costs. So as we think about how, the investment community is going to respond to these numbers, one of the things they're going to have to do is take up those production numbers, reduce operating costs. And as far as taxes are concerned, I mean, one of the reasons they had that improvement on cash taxes is they bought those assets from Chevron. That acquisition generated a lot of tax pools, and those tax pools can still be applied in future years. So as the street adjusts to these results, I think one of the things we're also going to see is the street taking down cash taxes for 2025, 2026, which is also positive for the financial estimates on the street for Canadian Natural Resources.
Okay, how would you characterize the operating results?
Yeah, I mean, the operating results were solid. As I said, I mean, a 2% beat on production. We're seeing record levels of production out of the company in their oil sands business, whether it's mining or in situ operations. And so really everything's going well for these guys. That's not a surprise. I mean, Canadian Natural Resources has delivered quarter after quarter of stellar results. So again, another great quarter for the company from an operating perspective.
So we get a lot of questions on the channel about this stock, and the questions often are why is the stock underperforming Suncor so badly and the broader energy index so bad? And you believe that is because of the perception of outsized exposure to U.S. tariffs at Canadian Natural Resources, correct?
Yeah, correct. So most recently, the stock has underperformed largely because of this tariff issue. I mean, Canadian Natural Resources is not an integrated company like Imperial Oil and Suncor. So those two companies can refine some of their production, and so they are less exposed or less reliant on U.S. export markets than Canadian Natural Resources. So I think that is a big part of it. The company has underperformed Suncor over the last year and a bit. Largely because Suncor has been doing a very good job at improving its operations, whereas Canadian Natural Resources has just been delivering consistently good results all along. So part of it is Suncor starting from a lower base and really re-rating relative to the industry leader, which is Canadian Natural Resources. As we look at it today, though, with the most recent sell-off in Canadian Natural Resources, it's lost, a multiple point or more valuation relative to its peers because of this tariff issue. And so we think that that's actually created a really good buying opportunity if you can look beyond all of this near-term political noise.
You think the underperformance in the share price is a buying opportunity for investors, and if I understand correctly, you've now made this your top pick in the sector. You've adjusted the ranking of your top five, and CNQ is at the top, correct?
That's correct. So CNQ, if you went back a few months ago, CNQ was trading, in line with the best companies in North America, including Exxon, including Imperial Oil, EOG, and other U.S. players. What's happened over the last couple of months with this tariff issue is Canadian Natural Resources has derated, and that's really created this opportunity because we think the stock will re-rate higher, again, back in line with those industry leaders once this tariff issue passes.
And on that list is Cenovus Energy, which is even a worse underperformance story versus the index or versus Suncor than Canadian Natural Resources is. Can we pivot to Cenovus and just give us your thoughts on that one? We also get a lot of questions on that one. Shareholders or viewers rather understand that the company is highly regarded as a oil and gas producer, and they look at the share price and wonder if that's a buying opportunity.
Yeah, so Cenovus is probably the least expensive stock within the group, particularly if you look forward to 2026 when their capital spending will drop and they'll get the benefit of some new production. The challenge they've had is the downstream business. The downstream business has struggled. They're still trying to figure it out. We've just seen some management changes, and hopefully that will start to generate some better operating results out of that downstream business. But the upstream business continues to shine. As you mentioned, it's one of the best in Canada, if not the best upstream assets. And, even if you just ignore the downstream business, make it a zero, this stock is attractively valued. But unfortunately, investors are really focused on that downstream business, which really means that it's probably going to take, several more quarters before we start to see them establish a track record of better performance in that downstream, which would then support a re-rating of the stock. So if you're patient, we certainly think things will get better, but it's going to take several more quarters.
The price of crude oil has slumped now to well below $70 per barrel. How much of a headwind is that for the entire group?
Well, it is a headwind for the entire group. I mean, the share price movements of this group is probably 80% correlated with oil price movements. And so declining oil prices is never a good thing if you're investing in oil and gas stocks. Again, we think that's largely driven by near-term economic uncertainty associated with Trump policies. But if you start thinking about some of those policies, clamping down on Iran, maybe refilling the SPR, those are actually all things that could be potentially bullish for the oil price that we don't think is reflected in current prices. And so, we're seeing some weakness right now, but I do think that oil prices will recover and move higher over the course of the year.
And another big theme in the sector was companies reaching their debt reduction targets and then turning around and putting all or almost all of their surplus cash flow into share buybacks or dividends. Does that story remain intact?
Yeah, it largely remains intact. I mean, as long as we're looking at an oil price above $60, I mean, the companies on average are generating free cash flow. Some of the industry leaders are generating free cash flow at oil prices down in the $45 to $50 range. And so that story is really intact at the kinds of oil prices we're seeing right now.
Randy, thank you so much.